All right, good evening, guys. Ken at Tortoise Capital. This is the Foundation's Q&A check-in for November 2nd, 2023. Um, finally got the book is published at Amazon, Foundational Trading, with that handsome spirit badger staring back out at us. Published by the Owl Group, so why is there a badger looking at me? Yeah, good question. Long answer. But pretty proud of the guys who really stuck with it. Great attention to detail. We're pretty proud of the work. So that it clears the deck for the next 9 books. So we'll get started on those. This was the back cover. Why did we write the book? I said, earn a sense of confidence in your own capabilities and judgment, and learn to work with trusted others on the same path to forge your lifelong edge in the markets, no matter what your previous experience has been. I think that's true. My brother said some nice things, challenging us to replace our beliefs with evidence. Phil says to empower traders with knowledge and decision making practical tools and structured learning techniques for market success. And Griff said trading something we can all learn to do safely when we're given the right tools by the right teachers. And all that I think is true. So pretty excited about that. All right, let's do a quick check-in with the team here. Jonathan, what you got? Let me put my ears on here.
So I'm doing fine. I'm looking forward to starting the foundations course next week, and I've been doing a little bit of simulated training in anticipation of that. So it's been kind of interesting looking at the new indicators and looking at the flow. And the reason I'd asked you that question earlier is it was kind of interesting experience. I was so drawn to the indicators, I kind of forgot about price. It's almost like the price became incidental, and had to remember to look at where price actually was when
Yeah,
the signals came up.
yeah, cool. Damien, how are we doing?
I'm doing awesome. Thank you for asking. I had a good day today, and I had the opportunity of having a long discussion with your brother this afternoon. So all is good.
Very good. And Joe, how are we doing?
Doing well. Kind of a busy week this week, so not as much progress on foundations as I wanted, but watched the Frogbox video probably for the 30th time today in the last 2 years, and it's finally sinking in. So there's signs of light at the end of the tunnel there.
Yeah.
And also very much appreciated your discussion last night about the compound critical state in the overall market, and just how important that is, and just something that most people never see. 1 in 10,000 are looking at that the way you do. So thank you for that.
Yeah, there's a certain edge. Today that thing paid off. Holy smokes.
No doubt.
What a day today was. AI, the stock. Wow. Greg, how are we doing?
I'm doing all right. I'm going through the grind, just powering through some notes on all the different exits and trying to figure out what works best. But I'm hoping that with a little bit more review and asking around, that those discoveries will become apparent.
Yeah, don't make it harder than it is.
Right.
I'll talk a little bit about that tonight again. Dwight, how are you doing?
Well, I've been doing all right. I'm pretty tired today here. All the fall activity around the house and cleaning stuff up is finally getting to me. I noticed that you, on your Amazon page here that you got on picture there that it's paperback. Is that an actual book? The last time we talked, it was going to be on Kindle. So
Well,
we have.
it's gonna get on Kindle. They're loading it onto Kindle, but it takes a few more days to do that apparently. And I think they're gonna come out with a hardback. I'm trying to get the source file back from the editors so that I can release a digital copy myself, so I don't have to pay Amazon 30% for the privilege of hosting my digital book. So
S-
that's work in progress.
All right. So we signed up for the email to come back when all this is available. So
Yeah.
are we going to be
Yep.
getting a Kindle one, or do we get the paperback?
Whichever one you want. I don't.
Oh, okay. So we got a choice now. Okay.
Yeah.
All right.
Yeah. I mean, at some point it'll be, you get the one you want. It's,
Oh, all right.
that one was I guess, is the paperback. So then Amazon gets paid more on that one, I think. That's probably why they accelerate that.
Yeah.
And Kurt, how we doing tonight?
Hey, doing good. Just getting caught up on coursework and still successfully paper trading the Kata challenge and enjoying that during the day. So
Good. Well, here was today. I'll just to get warmed up. So this is the. I'll cover this one again tonight too, but it's worth sharing. So this one demonstrates the visual box trading technique, and in this one, all we do is we notice that at the close yesterday there was a long period of time when it just is grinding sideways, and you can draw a yellow box around that. That's how much it varies when there's nobody actively trying to push the buy or the sell. Right? So that's just the algorithms trading back and forth to each other. And it turns out that's pretty close to the R10 MMRB. But I just draw a visual box around that. Then there was a very large gap up on that. It went from 24 to 25, so something like a 4 or 5% gap. That triggers the alert. It was the largest gap of anything on my tradable stack. I observe it. It moves MMRB off the low of the day, so I just hold my nose and buy it. It immediately goes up, and after the second leg up and it rolls over, I take the exit at the skin of the dragon for 5R. About 30 minutes later, it gives me a Kata 2. So I just re-enter with market's money because why not? It's above the VWAP, the RL10 has come through the dragon. Hasn't quite gone through the PSAR yet, but feels all right. And then that one turns out to be, it's a grinder. And at this point in the this was just right around lunch, around 12:30 or so, 12:30. It was up almost another 5R, so I locked in 4. And if I remember right, this it exited somewhere in here within the next half hour for that leg. There was another afternoon move where it went up another buck, but still, that's about almost 9R just by being prepared to trade one of the standard tradables, and that would work pretty nice. So I was happy to see that one. All right, let's get to the meat and potatoes today. While searching for something, I found something else. I'm going to upload this one in the foundations course. This was practicing the coach's eye. I don't think I put that in the foundation. I may have put it in there. But on September 5th, my birthday, I was reviewing somebody's trading plan, and it turned out to be a pretty good set of notes. And so when I talk about practicing the coach's eye, what I'm saying there is that you are typical as a trader in when you're learning a new system to think like a trader about the trade, and you're locked inside the bubble of the trade itself, hooking and jabbing and trying to get it done. And then, you want feedback. So I could ask a coach, hey, coach, observe that trade and then give me some feedback about what you're seeing so that I can make some changes in my technique. So what we want to do is when the trade is over, we want to be able to step outside and adopt a coach's eye to look at our performance over plan, prepare, execute, and assess, and take on the role ourselves of having a coach's eye. One of the powerful ways to use the chat room in my coaching is for you to practice doing that before you hear me comment on your trade. Or on the trade of others. Like you could go into the chat room and take a look at the trades that traders have posted, make your notes on them, and then say, I wonder what Ken is going to say about that. And so if you make a set of notes, what do I think Ken is going to say? And then compare it to what Ken actually says. You can look for you and me, right? And this is the area where I said it and you said it. Well, hopefully that's a good thing. But then you're interested in the things that I noticed that you didn't. Because then that becomes, I wonder why Ken's looking at that, or, oh, maybe that's a new thing to look at. Aha. And then there's things that you notice that I didn't mention. Why didn't he say that? What is there about that? And it may be, hey, I didn't see it or didn't have time to say it, or maybe it wasn't important to me or whatever. But it's asking the question, and what you do is you get a chance to look at the trade critically. You get a chance to look at my stuff critically. You get a chance to look at your own work critically as a coach. And when you practice doing that, you end up being able at will to adopt another role in your arsenal, in your repertoire. What you'll find is that in the middle of the trade, you can actually step outside of the trade while it's going on and look at it from a coach's point of view or from different coaching points of view so that you don't get locked into the trade itself. It will help you de-emotionalize your identification with the trade. Like, you're not the trade. You're just the guy that put on the trade, and now that position is moving along, and now you can render a dispassionate judgment about it. And so being able to adopt the coach's eye allows you to see not only what's going on inside the trade, hey, what's going on in the market? What's going on in the sector? What's going on in other trades that I might want to be in or which have information value? So when we talk about practicing the coach's eye, I think the most powerful use of the chat room is that when you post a trade, that you then mark up your coach's notes, put those on the chart that you're marking up. Commit to that in public. And what that does is it forces you to look at the other things that you see on the chart that maybe you didn't see because maybe you had tunnel vision or you had screened it out, but now you start noticing other things. And then listen to me with my notes or the notes of others, and now you can compare and contrast, and you'll come to a deeper understanding of the trade, of your skills as a coach, of the points of view of your fellow traders and coaches. And this is actually how you become a very good accountability partner for yourself and for others, and it allows you to self-actualize. So, I'm not going to read all these things, but I will post the document. And so these are all things that we talked our way through about looking at an existing trading plan, a trading strategy, and questions we might ask about it, about the changes that were proposed to make. Because this was the case where the trader had a written trading plan, and then had accumulated some evidence, and then on the basis of evidence was proposing to make a change in the way he was trading. And so I wanted to say, hey, let's take a look at what you thought about that justifies moving to this new trading plan. Let's take a look at your process for evaluating the data and the rule set, and then coming to the conclusion about what should be changed. So the process of making the change is really what this set of guided questions are. And the discussion of it I thought was pretty good. And it was from back on 23/09/05, so September 5th, 2023. Anyway, I wanted to share that one. All right, let's. Okay, so Hamad asked, how should we look at the PSAR? And as I started writing, I say, is he kidding? Really? As many times as I talk about this, are you really asking me that question, or are you just trying to provoke a response? Any tips or recommendations are, highly appreciated. And I thought, oh, maybe he's serious. All right, well, here's how I think of the PSAR. Use the PSAR for exits. And the exits are the most important part of the trade. So the PSAR is the most important indicator of anything on your screen, on my screen. That's what I think about it. This should not be surprising, but maybe it is because maybe I haven't emphasized it. But the PSAR governs how I think about the exits. So if price is moving up and starts to roll over, and the PSAR is moving along right here, the PSAR governs how I think about the exit. It doesn't mean that it's always the exit. Like, this may have moved so high to the top that I'm unwilling to let it go further down to the PSAR. This may have been such an exaggeratedly strong move that it pulled away much faster than the PSAR could accelerate. But because the distance from the price to the PSAR is so great, it tells me that I need to activate a sniper exit, because it would be unsatisfying to let it come all the way back to the PSAR. So in that sense, the first place that I look to about where the exit should be is the PSAR. Like, it should never be lower than that. And having said that, there are times when the Bollinger Band mean might be the appropriate. That might be the SMA 30 might be an appropriate exit for one half of a position if I'm using that as the manager exit and I'm using a 2-bar low as the sniper aggressive exit. Maybe that pairing is good. And when I do that, it turns out that the PSAR is right in between those two. So, in general, I will say PSAR is the most important single indicator. Well, why? Because it tells you something about the price, the length of trends. You know, what you want to do is you want to trade something that the PSAR looks like that, and then when it goes down, it looks like that, and then when it reverses, it looks like that. You want these long, powerful strides that allows you to trade in both directions. So the length of PSARs, how many dots in a row before it flips, tells you something about the trendiness of the target that you're trading. And if you know something about that, like, hey, it wouldn't be surprising for that thing to have 15 bars. And we're in bar 5 of what could normally be 15. I'm still in the early stages of a normal move for that target. So the PSAR will tell me about trends. It tells me something about the size of the risk box. So because we're using the RL10 equals price, and that is the price that is driving the dots, when the PSAR hits, when the RL10 crosses the PSAR at the close, that's when the PSAR flips. So it's the RL10 crossing the PSAR that governs the flipping of the PSAR. And when that happens, it tells you the size of the routine risk box. Now, that's not the only thing we look at. If we're looking at the 3-minute bars and 30-minute bars, we're going to compare that to the R10, maybe the R6, and maybe the R3, and maybe the frog box. We're going to compare it to the range stat so that we can see what the statistical suggested size of the risk box ought to be. But as a default position, I'm prepared to say that's a pretty good default risk on the time frame that you're working on. Now, on the 3-minute bars, that might be 20 cents. On a daily bar, that might be $2. But the relationship to the price when it was trending this way and now it's trending that way, that gap between the dots tells you what the transition, the size of the transitional zone. That's the noise between the rivers. So if I'm short here, if I got short here because price went up and came down, and I'm short here and there's my risk box, then this box represents the noise. Like the original trend that was up doesn't start until the PSAR gets violated. So that tells me something important about the nature of that target that I'm trading. It tells you the size of the risk box. So if the PSAR tells you something about the length and duration of trends, and it governs, it's the central fact about exits, and it governs the size of the risk box, and it's based off of what we're using as price, which is why our PSARs are so smooth. I would say it's the single most important indicator on the chart. And I've actually traded with no other indicators except the PSAR, and I've turned off price and said, when the PSAR flipped, I just made an entry. Wherever it was, I just accepted the entry that I got, the opening of the next bar. Try that sometime and see what happens. In fact, take some long period of time, plot the PSARs and the flips, and say, well, according to the law, I should be short here, and I should be exit. And if I just stop and reverse, I should be long there, and then I should be, I don't know, short here. Whoops, short here. And so put all those little dots on it, and then turn the price on and see what you get. Like this is the size of your risk box. And then see what kind of trades you get. You're going to be surprised at how nice that is. Now, Greg G says, when the PSAR flips often in short bursts in chop zones. Well, yeah. If you're in a sideways quiet channel, we don't take signals in there. That's like if you have, to get a COTA 2, you had to have a successful trade. It kicked you out, and then it reversed quickly, and then that should be your signal to get long. But if that one doesn't work and you exit, you're done. You don't just keep taking it because the PSAR flipped. The precondition was that you had a successful trade after you took the standard exit, and then you got a COTA 2 reentry. The precondition was that I had that good move. That's not a sideways quiet channel chop. In fact, one of the signals that you shouldn't be trading that thing is frequent PSAR flips. You'll also notice that that's what happens when the Bollinger Bands start tightening and the dragon starts wiggling like this. Then you're going to get some PSARs that look like this. I should put that in black. So that's why we don't trade those until the Z3 lines compress to within some tight measured box. Intraday, that's a frog box. On daily charts, that's an ATR. So where you get chopped up is when you have a sideways choppy market which has not compressed enough to be abnormally compressed. You need to see the Z3 lines get inside some box which says, this is an abnormal compression. This is abnormally quiet. In the sniper trade, you see us with that all the time. That if you go back, we look at 5-day volatility in the sniper. What do I mean by 5-day volatility? I mean, take 5 days. What was the highest high of the 5 days? What was the lowest low of the 5 days? That's how much volatility that there was. So you got to divide volatility by the price at the close of the 5th day, and that will give you a volatility percentage. So if you go back 150 days, what that means is you have 5 days, 5 days, all the way back to 5 days. You have 30 5-day segments. which is statistically significant. So you find out what the volatility percentage, the average is of those 30 5-day periods, and then you rank that by least volatile to the most volatile. And if that's the average, and that's -1 and +1 standard deviation, we don't trade the ones in the middle. Not interested in those. I want the ones that are abnormally quiet or abnormally volatile. Why? Because this 5-day, if it's right here, one of the 5 or 6 quietest 5-day periods of the last 150 days, that means that the 5 days have compressed to a small enough bar that a breakout from there is going to catch everybody by surprise, and you're going to have a small risk box, and you're going to have a large move in whichever direction it goes. So the abnormal volatility is what I'm stalking. Now, when I have a great big, long, strong move that's starting to roll over, the Bollinger Band means are going to be at the widest point because you had this huge directional move. So the Bollinger Band means are wide. That means it's in play. That means I can start taking Kata 2s and collapsing dragons in here. But if they don't go anywhere, if they stop working, then what you got is the Bollinger Bands starting to compress and price compressing. So you cut that off after 1, at the most 2 failures, and then go somewhere else. You don't keep trading it just because the PSAR is flipping. You traded it because you had a great big long strong move and it flipped. You need both of those conditions. Or you have watched this thing go nowhere for so long that it actually compressed, and now it's in this very tight range compression where it's like a tiny little acorn. And now the compression is so small that the move out of it is explosive. So there's 2 conditions that we want to see in the life cycle of volatility. We want things that are abnormally volatile. Why? Because they're already in play. Momentum is happening. The thing is on fire, moving now. That's why on the one I just showed you, it had a large gap. It was the largest gap of anything in my stack. And it opened, it sold off briefly and started going up after it closed here. So there's a large gap. That means it's in play and it's moving. It's abnormally volatile right from the get-go. So that's the one that's going to be most likely to have an abnormally large move today. So I can just find the low of the day. Well, where was it? I had it somewhere. Oh, there's the low of the day, and I put a little risk box on it, and it moved out north of it, so I just buy it because it's going up. I get my stop in. My risk is out. I have no idea where it's going to go, but it could be a range stat day. It moved 5R before it even hesitated once. It rolled over, and it gave me 5R. I didn't predict 5R. It's just I just keep moving my stop up, and when the price hits my stop, I'm out. And whatever the number is, that's what it gave me. My job is to find the mover, make the entry, get my risk out, and adjust the stop, and then keep score. Find out what the number is. Oh, 30 minutes later, after it sold off, it makes a Kata 2. Long. Up, it moves another 4. So, yeah, the answer to your question is, yeah, lots of chop in the PSARs tells you that it's not working. You'll also see that because the Bollinger Band means are closing. Jonathan asks, is the sniper trait an SSC, CD, and a COTA 2? Yes. The sniper consists of one of 5, and I don't teach the sniper in the foundations, to be fair, but I'm going to teach it in the foundations. So the sniper is 5 patterns for a setup. It can be any one of 5 patterns that suggests this thing is in a compound critical state. That's all it means. We have identified 5 definitions of different compound critical states, which means that that thing is ready to break large in either direction from a small wrist box for reasons that are statistically derived. And once the day starts, if you're trading the sniper intraday, because you can trade it on other time frames, but if you're trading it intraday, we're looking for SSCs, CDs, COTA 2s, Z3Ps. And you can trade the Z3P right from the open. We treat that as a pinch box, and we put a minimum manageable risk box on either side of the open, and we play the first break out of it just like the hybrid frog. So that's one pattern. You don't have to trade that pattern, but you can. And then if you don't trade that one, the next thing we have to see is a SSC, which means that it had to have a large, abnormal, incontrovertible, indisputable, harsh winter. What's that mean? It means 1.5 frog boxes. It means that the MACD histogram has left the Red River, and it is clearly a harsh winter. And that means that we're now getting ready to set up for the SSC. And if the SSC fails, we play a CD. And if the SSC works, we cash a winning trade. And then we keep taking COTA 2s to the upside until they stop working. And then at any point during the day, on any of these that are in a sniper setup, if any of them trigger a Z3 pinch, which means on 3-minute bars, that one frog box contains both Z3 lines. So there's 6 little local standard deviations inside one frog box. Then it is abnormally compressed, and we can play a Z3 breakout at any time of day intraday. And if that fails, like if it fakes 1 and goes 2, we will stop and reverse on those up to twice. So, in conclusion, the sniper intraday consists of 5 compound critical states, which can be traded with one of 5 standard patterns. I trade those on 1 minute, 3 minute, 10 minute, 30 minute, 2 hour, daily, 3 day, and 9 day patterns. Those 5 standard patterns are fractal, and I am prepared to trade those 5 patterns on any of those time frames. When I'm trying to be a sniper, I am including specific categories of setups for something that I think is ready to move today large on 3-minute bars. A intraday sniper is a special form of how to use those 5 standard patterns with 5 standard sniper setups. Now, it turns out that the 6 swing systems that are mechanical filters and mechanical setups, it turns out that those are also good signal generators to do intraday trading. And I'm ready to trade the 5 patterns on anything that triggers one of the 6 swing trade patterns. But it just turns out that the sniper, nobody else on the planet is looking at those setups. So when they start moving, it always catches people by surprise because it's an unusual way to look at the world. But the principles of how to use the 5 patterns that I teach, what's the commonality between all of these things? The 5 patterns and the idea of a compound critical state. Now, how many different ways are there to identify a compound critical state? Probably an infinite number. My hypothesis is that every mechanical system that has some set of rules that allow you to select a target and then trade it in a certain way. My going in position is that anybody's rule set that is robust over time and kept working probably is finding something like a compound critical state because it's giving you the preconditions for what turns out to reliably be big moves. And maybe it's only a move in one direction. Okay, so whatever. What's beautiful about the compound critical state is the idea that we are prepared to go in either direction. That's the foundational concept, the idea of a compound critical state. The idea of the compound critical state is that there are multiple independent demographics of traders who are in an emotionally agitated state about their favorite target and are especially prepared to go long or short because of extra reasons that pertain to their time frame. Like a guy who is a swing trader and wants to hold positions forever or hold positions forever says, "Oh shit, oh heck, it's time for the quarterly earnings announcement. Tomorrow is a special day for Oracle, the stock. So tomorrow, of all the days in the quarter, I don't even pay attention to the stock. The one day I pay attention to the stock and I'm ready to react special is on the day that they announce quarterly earnings." So, if today is a day that Oracle is announcing quarterly earnings, then everybody who is a long-term buy and holder maybe is ready to trade it at a higher state of agitation. So he's going to start buying and selling when normally he doesn't. And all the money that's tied up with that guy is ready to act and push price around, which creates a lot of volatility that doesn't usually happen except once a quarter. Well, maybe the guys who are swing trading it notice that it just made a 10-day low and they think because it's in an uptrend, this is now a prime time to buy on a dip. So all of the swing traders are ready to trade it if it shows any life with an extra pile of money. Well, now all the long-term guys, all the swing-term guys, and maybe the day traders are ready because they notice something in the options or the level 2, whatever. Now suddenly I get 3 different independent sets of demographics who are all prepared to trade it much heavier than normal. And now all of a sudden some trigger event occurs and it makes a move And that move triggers some momentum, which triggers another system, which triggers another system, and then the machine learning systems come in and start rewarding short-term momentum, and pretty soon you've got quadruple the normal volume and triple the normal daily range, and 100% of the people are surprised because they were only expecting it to trade the way it trades when they trade it. But now suddenly everybody's losing their mind. And tomorrow it'll be large because all the end of day traders saw, oh my God, look what it did today. I got to take action tomorrow. So when it comes out of a quiet, abnormally quiet state and makes a huge move, that usually has ripple effects for 2 or 3 days. Well, you might get in 2 or 3 days as much price volatility as it gets in an entire quarter, but you get to participate in that over the course of 2 or 3 days. And you don't have to get all of that. You just need to get a nice bite of it. And then if you have 50 things in your little bucket and they are going in and out of phase at different times, pretty soon you always have 3 or 5 things that are ready to go today. And when they start going, you jump on them and you don't stay connected to them because you think it's going to last forever. No, it's like AI is going to have a large day today and tomorrow and maybe the next day, and then it'll be done for 3 weeks or something. I don't know. Anyway, the Foundations course teaches the idea of the compound critical state, and it teaches you the central 3 patterns that are fundamental in every decision to begin trading a compound critical state. It says, wait for a harsh winter so that you know that it is in play. Why a harsh winter? Because the fear that's triggered by a harsh winter is more likely to be an over-exaggerated emotional response than a grinding gain, because that's driven by greed. And fear is 3 times as powerful as greed. So if you see a huge downward move, there's a greater likelihood that that's an emotional response, which means it's going to reverse or it's going to run away. That means the second move is going to be large after a harsh winter. We just don't know which direction. So when we see a harsh winter, we have the first criteria of an SSC, which is the reversion to the mean, the reversion to the fair value that was the fair value before the harsh winter occurred. Now, does it always do that? Does it always go up there? No. Nothing always works. But it reverts enough that it's positive expectancy when traded properly. Because we're getting it around 1/3 of the way back up the stack, or maybe even 1/6 of the way, so we still have most of the move back to fair value. And if we only get half of it, then we make a 1R win compared to the amount of risk that we took. So we're aiming for 2 and we'll settle for 1. So the first pattern we teach is the SSC. Yeah, but what if that fails? Well, if it fails, we're actually into the next pattern, which is our favored pattern, which is the collapsing dragon. So we're in the position of learning to trade the SSC first. And when it works, it pays off. And once it successfully works and then you sell, it can lead to the third pattern, which is kata 2s, all the way up the stack. But if the SSC fails, you're into the primary pattern, the one we love the most, which is the collapsing dragon. So that is the minimum set of patterns that gives you a complete strategy of what to do after an abnormally large sell-off. When you get the criteria For an SSC, you hold your nose and you take it long, but if it fails, you take the collapsing dragon. But if it succeeds, you take kata 2s until they stop working, and then you're done. You don't keep doing kata 2s just because the PSAR flipped. It had to have a successful SSC for it to be a kata 2. Well, after all of the energy and emotion of the harsh winter and then the subsequent reversal or the continued follow through to the downside happens, when all of that energy dissipates, you end up getting something that looks like this. And if you continue to try to trade it forever, when the Bollinger Band means when the Bollinger Band means peak and then they start compressing, somewhere right around in here, the size of the moves are so small that you're getting chewed up. You're taking 0.2 and 0.3 losses and nothing's working. Okay, so you're done. And then you got to wait until the Z3 lines have compressed enough so that they have fit inside of a frog box. Now the compression has reduced so much that it's quiet, so quiet that when it breaks out, it catches everybody by surprise. And now the run begins again. So, at the start of the day, at the open, we exactly don't know where it's going to go. We know it could go a range stat up and a range stat down. Just don't know. So we have no information about what kind of a day it's going to be. The only way that I can trade that is to put an MMRB on either side of the open and just play the first breakout and try to get my risk out. When that works, like it did today, then I'm already in the position that became the harsh winter. And then the SSC or the next collapsing dragon, I've already made money off the first move right out of the open. That's the logic of the OR3, which is an advanced day trading technique. I don't teach that in the foundations course, but you see me doing it every day in the nightly podcast, so I almost feel I should tell you what the OR3 is. The OR3 is simply one way to classify the opening 3 minutes and then play the breakout from the opening 3 minutes and then get my risk out. So if you don't want to wait for the harsh winter, but you want to start trading early in the first 30 minutes of the day, the way I do it is I find the ones that have the biggest gap or zero gap, because that's like an abnormally no gap. A zero gap is the smallest gap you could have. That's abnormal. So I put a bracket around no gap, and then I find the ones that have the biggest gap, and I put a bracket around it, and I start trading those on 3 minutes. I try to get 2 or 3 symbols going in the first 30 minutes using 3-minute charts. And then at the 30-minute mark, I start using 30-minute bars for all of the other things that are just routinely grinding along on 30-minute charts. And I have about 30 symbols in my stack, and it takes me 4 seconds a chart to judge them, which means that in 2 minutes, I can look at all 30 charts and make a decision, and then I have 28 minutes to fiddle around with the 3-minute chart on a couple symbols. And I do that all day. I pick 2 or 3 things that I'm monkeying around with right now on 3-minute charts because they're moving. When they stop moving, I take the big trade off or I leave the trailing stop on or whatever, and then I go find something that's moving based on what they're doing on the 30-minute charts. Because the 30-minute chart could go into a compound critical state on the 30-minute chart. So, the PSAR, the most important indicator. RL10, it's the price and it marks the endpoints of the trend. So if I could only look at one thing, I'd look at the PSAR. But if I could look at two things, I'd also look at the RL10, because the RL10 comes to a sharp point at the end of trends, and that's where the collapsing dragon gets triggered. So when the PSAR flips, to the bottom and starts going up, and then if price gets me long and then it fails, the peak of the RL10 is where the stop was that launches me into the collapsing dragon. So it is actually fair to say that the current channel can be defined by the two most recent turning points of the RL10. That's the size of the channel. Is that channel tradable? Well, cut it into thirds. And if it moves off that and I give it a third and I can get one or two, then it's if that's tradable, then it's tradable. What you'll see quickly when the P-star starts flipping is you'll get the RL10 starts looking like this, and pretty soon it's so narrow you can't trade inside there. Is it narrow enough to do a Z3P? I don't know. Put a frog box on the Bollinger Band mean Z3s, the Bollinger Band Z3s. When they are inside a frog box, then it's compressed enough. But if I could look at three things, then I would look at the dragon, which is the 10 simple moving average with the Bollinger Band plus or minus 0.5 on the 10 period. And so that gives me, if the RL10 looks like that, then the dragon is a little bit slower and doesn't quite get as high, and it lags a little bit. And now if I notice that as the turning point, I can get short right here, and my risk box looks like that, and I'm going to probably have 2 to the next turning point. And when I see that turning point, I get an entry when the RL10 crosses the dragon, and my risk box is going to look like that. So the combination of the first extreme turning point of the RL10 and then the turning point of the dragon gives me actionable information and it gives me enough time to practice and set up and set my frame and judge where the turning point's going to be and do I have a tradable frame. And then if I could look at another thing, I would look at the owl, which is the RL30, which is the health of the trend. And when the RL10 turns, the RL30 turns a little bit later. It usually turns after the dragon turns, and that's the 5th criteria of the owl entry. And then if I could look at a 5th thing, I would look at the Bollinger Band mean, because when that price moves an extreme distance, the reversion to the mean is going to be back to the middle of the river, which is the SMA 30. And a move from here back to there is leg 1. And if it blasts right through there, it'll give me leg 2. So if I get short and it comes to the Bollinger Band mean and starts to waffle, I'll just get out because I'm in the middle of Crocodile River and it's not flowing to the other side. What I want to see it do is I want that to be such an extreme move up that when it turns and I get short, it just blasts all the way back. And there we go. So Hamad asked, what do I think about the PSAR? What should we look at? I look at that PSAR in that following way. But it's also in conjunction with those 5 things. I think those are the only 5 you need. You could maybe add the Z3 lines if you wanted, so you could tell if it's a Z3 pinch. But literally, you could tell a Z3 pinch from a mile when you see that the damn price is squeezed into that, and there are no momentum trades working at all. I mean, that's sort of an indicator. So maybe I would add the Z3 lines if I was going to put a 6th thing on. But all of those fit together into this strategy. I thought he was kidding me on this one. How would I recommend that we trail our stops? I can't count the number of times I've said what I'm about to say again, so I'm just going to say it one more time. Now, this is his proposal. I don't have any qualm or quarrel with any of that. But this is what I always say when people ask me, well, Ken, what do you recommend for trailing stops? This is what I recommend. Number 1, trail with an MMRB. Whatever your initial risk was, just trail it from the highest high. Just do that. But if you can't just do that, then I would say the next thing you could consider is to use the PSAR. And wherever the PSAR goes, let that be your stop. Where does that get you in trouble? That gets you in trouble when your initial move was huge and then starts to fail before your PSAR ever gets above your entry. So you might have had a catastrophic success, and then it all collapses and you lose money at the PSAR because you were trailing with the PSAR. If you were trailing with the MMRB, you end up getting out up there on the explosive goodness. Yeah, but sometimes you'll get 1 or 2 bars of goodness, and then it reverses, hits your trailing PSAR, and it would not have hit, or it hits your trailing MMRB, but it wouldn't have hit your PSAR. So now I don't know what to do. Here's what you do. Trail the MMRB. If you have a better idea with the PSAR, trail with the PSAR. Or look up what I say with the Uwe exit, which is you have a tight wrist box where the PSAR flipped, and you leave that in place until the PSAR gets north of your entry by 3 bars, and then and only then you jump it up to the 4th bar because it just closed, and you put it right there until the Bollinger Band mean reverses and takes out this one, and then you pick up the Bollinger Band mean, and then you trade up to the PSAR and trade up to the lower skin of the dragon and then the upper skin of the dragon. But when you get above 2R, you have an abnormally large win, so you should take special consideration at greater than 2R and use a MMRB trail. No matter what you did in here, once you get 2R in hand, trail with an MMRB. Here's some things to check. Whenever you put together your little personalized rules for what you're going to do, here's 3 spot checks. I want you to figure out at 0.7, if you have a 0.7 open win, I'm ordering you that your stop should be at no lose plus dinner for 2, which is about 0.2. You should be at no lose plus dinner for 2 when your trade is at 0.7 of a win. When you are at 1R win, you should be locking in half an R of gain. And when you are at 2R, you should be locking in at least 1.3R so that you keep 2/3 of an abnormal win. As long as your little specific rules meet those 3 criteria, then I'm satisfied that you understand what I'm teaching you. But for the love of God and all that is holy, trail with an MMRB until you've got 500 trades, and then you've studied the exit and you think that you have a better set of rules that allows you to capture more. That's what I'll tell you to do. Now, he asked me what was an approach for the day. All right. What I just said before. Use the sniper trade of the day on 3-minute bars to get started with a couple symbols in the first 30 minutes based on gaps and alerts. Then, after 30 minutes, shift to survey the other symbols on 30-minute bars that are using that hybrid swing trading like you see me do every day so that you can trade more symbols. Then, decide which 1 or 2 or 3 symbols that you're going to use 3 minutes on as it shapes out during the day. When they stop moving, retire them, put on something that is moving, but don't exceed your span of control. Do that as much as you're capable of during the day. Use the lunchtime as a special midday review to find the things that were moving this morning, and then decide if you're going to do an afternoon session when they come out to play after lunch, and you might get a second big set of moves. And then you treat those as 3-minute sniper trades of the day. About 90 minutes before the close, make decisions on what to close and what to keep on the 30-minute chart overnight holds. Most of the time, cash them. 1/5 of the time, hold them. But only if you have at least 2R in hand as a buffer for the gap. In the last 30 minutes, the ones that you decided to hold overnight, confirm that you really want to hold them overnight. Because maybe something happened in the last 30 minutes and you just can't stand it and you want to take advantage. Now, in that last 60 minutes, start framing the trades for tomorrow's follow-through on the basis of today's moves because you already know where the key price points are. Start doing tomorrow's work today and get those frames done before the market even closes. If you also want to trade Forex after the market closes, you could then shift to do Forex pairs after the equities are closed and there's nothing else to do. And then conduct your after action review, establish, map, and document your daily trading practice in terms of the daily AAR and what you're going to fix for tomorrow. Use a 1-page checklist of process control reminders and a checklist to make sure that during the day while you're doing 1 through 9 that you're actually doing the things you said you would do, including getting rest, eating, stretching, meditating, scanning broadly, and then doing deep focus dives. And then compare your work to the Nightly Strategy podcast. So then he has the chutzpah to say, how do we do after action reviews? Seriously. Seriously? Okay. There's 4 phases. Plan, prepare, execute, and assess. There are tasks that you got to do with each one of them. It's in the foundations course, what you got to do. Now, as you look at your planning phase, what are the key things that you did well that you want to keep doing? Those are the sustains. What are the things that you did poorly that you want to stop doing? Or what are the things that you didn't do that you should have done so that you can add those? And those are going to be the things that you list as improvements. Then, when you can then do prepare, execute, and assess. And when you have identified all of those, you list the things that you specifically could do to fix tomorrow. And when you've listed those, pick 2 or 3 at the most that you're going to commit to with accountability, and then fix those tomorrow. And then post that in the chat room along with the charts that you post to get feedback on the trades. Show me that you're doing the work of process improvement by posting your one chart. You're going to quickly realize that if you go overboard listing every single goddamn thing, it's hard to sustain that level of energy. So you got to find ways to quickly hit the most important ideas that are going to have the biggest payoff. How do you do it? That's how you do it. When should you do it? During the day, if you notice with your coach's eye that you made a mistake that you don't want to repeat tomorrow, go to your daily after action review and write it up. So, yeah, I screwed that up. Or, hey, I really did that well. I want to make sure that I know. So make notes in a handwritten form during the day on one sheet of paper with a pencil. And then it's done. And finish it up right at the close. When should you do it? During the day and as soon as the market closes, after you give forgiveness and gratitude for the trading that you just did. How often should you do it? Every single day, without fail. Every single day, without fail. That's how often you should do it. And then you should review on the weekend all 5 days and look at the quality and consistency and repeatability and the trends for that week. And then at the end of the month, look at all of your weeklies and come up with a grand master plan for the month and all of the performance stats for the entire month of trading, intraday, swing, and long term. And come up with a half a page summary of your monthly performance as your senior executive review. That's how you should do it. That's how often you should do it. You should mark up every trade. You should review the day at the end of the day. You should review the week at the end of the week and review the month at the end of the month. And then quarterly, make a 10-minute presentation on video and share that. And then twice a year, sit down with me and let me review the videos or whatever, and then do an annual research weekend to report on your progress. That's how often you should do that. Rajiv said, I'm working through material and listening to the nightly. As I focus on the WMB3, could you recommend which symbols I should focus on? Yeah, 100% of the symbols that are on my daily watch list that you see me tracking every day in the hybrid swing. Those are the ones you should look at if you want to compare your trades to my trades, because that's easy. I pick the ones that move reliably every day. Those are the ones that you want to trade every day. If I had to take a subset of them, I would start with the left side and go to the right until you ran out of capacity to manage them. Brazil, Mexico, Devon Energy, Tesla, Diamonds, Cliff, Alcoa, Intel, Microsoft, and Win. Those are the ones that I would trade. I'm noticing that WMB3 patterns fail fast. It's a good time to reverse and go short. Yes, and that WMB3s work great on big gaps with high fraud quality numbers. Yeah, large gap is automatically in play, as I just said. And the WMB3F is an excellent reversible signal for anybody prepared to go short, because it's a brilliant trade when it recovers because it started off so bad. But in the same way that the collapsing dragon is beautiful, the WMB3F is also beautiful. It doesn't require all of the RLCO framework to work. You can do it just with visual box trading, but it's an excellent internal strategy that works in both directions. Mark asked me, is the VWAP a strong indicator of Forex in the stock market since it's not a centralized exchange? And later he said, and a lot of the experienced Forex traders I say it doesn't work. I agree. I'm not a Forex expert, but you don't need the VWAP to trade the Forex pairs. So I don't put much weight on it. I have it on my chart simply because I always have it on every chart, but it doesn't have much power to explain on Forex. That's correct. For someone who could be trading either the Forex or the US stock market, where would I advise? He sees clearer and more compressed patterns in stocks. Well, I would say, do you want clear and compressed patterns? Then trade stocks, because you already see that that's what they behave like. If that's what you want, then trade stocks. I would say that I think on the longer time frames, the Forex is smoother and more deliberate. There's a lot fewer pairs to study, so you could be expert of the entire Forex market on 6 pairs and specialize in 2 and be done with all of the extra work I do for equities. There's less intermarket and intra and intersector dynamics, so it's simpler. The trades can last for days, weeks, and months because they're often driven by macroeconomics and policy changes that take months and quarters to unfold. So you can actually track that for much longer swing trades. But at the same time, intraday, it's not unusual to see 3 different times a day when you get large spikes and then failures of spiky breakouts. So the reversion to the mean works beautifully. The Z3 pinch works especially beautifully, but you have to be ready to capture the move. If you were going to trade them both, I wouldn't trade them at the same time. I would at any one moment be either an equity trader until they close and then go be a Forex trader, or I would just be a Forex trader until the equities open up. Then I would get out of the Forex and then I would go trade equities. Until such time as you could actually blend them. The problem with blending them is that you're probably going to work on different time frames with different length of trades and different patterns, and that'll just cross your wires if you're not careful, and you'll be muddling the 2 environments together. So probably you're operating on different time frames for them as well, so don't cross the wires. But play with them both and see which one aligns with you and feels satisfying. What do the results say? The patterns are fractal. He then asked me, he's about 55 trades in. Should he finish his first set of 100 trades, or can he start making the changes that he already identified? I said, finish trading your current strategy on 100 trades so that you know what 100 trades feels like and you have more data. But I also think, as skilled as he is, he could run a separate experiment on his modified rules and keep 2 different sets of buckets. 4th question. Starting the trading session on the 3-minute time frame, I noticed days where price acts in an unusual way, very wicky and choppy. The price hits the PSAR repeatedly without flipping the PSAR. Yeah, that's because the wicks on the candles are noise. That's why we say that the price is the RL10. So the RL10 is going up and the PSAR is down here, and the price bars may be hitting it, but the RL10 doesn't, and so the RL10 doesn't trigger the PSAR flip. The PSAR doesn't flip until the RL10 breaks through the PSAR, then the PSAR flips. So this is noise. But if you notice that the price is hitting the PSAR a lot and you don't like that, and you're not ready to treat the PSAR as price, well, then you've either got to shift to other targets that are behaving in a more orderly fashion, or learn to focus on the RL10 as the signal, not the price wicks, or shift to a 10-minute time frame, time bar, or a 30-minute on that target so that it smooths out. If the 3 minutes is too jumpy, shift to the 10, shift to the 30. I shift between those four all the time because they are fractal with approximately a factor of 3. 1 times 3 is 3. 3 times 3 is about 10. 10 times 3 is 30. If I want to go faster, I take 30 divided by 3 is 10. If I want to go faster, I go 10 divided by 3 is 3. 3 divided by 3 is 1. So those are the 4 time frames I work on. One is fast and one is slow. I typically rely on the 3 for fast and the 30 for very slow because there's a factor of 10 to 1 between them. That's why I choose those time frames, because they work for me. And I can manage 3 symbols on 3 minutes and 30 symbols on 30 minutes easily. So it just works out for me in terms of span of control. I think this was Lou. Possible entries for a CD. Here's the example. And this is exactly what I just said about the RL10 is the price. My preference is for the RL10 to come through the Dragon, or to come through the, through the RL10. I would like price to be an orderly descent so that when it goes through the RL10 goes through in a nice orderly fashion. But sometimes, like you see here, accelerated, accelerated, accelerated. I'll take price going through the bottom of the RL10 because the next bar could be huge. So on the downside, I am ready to take price going through the RL10 because when price collapses, it can be so fast that you miss the move if you wait for confirming evidence of the RL10. Now, the next choice is I might be able just to watch crap, it doesn't, I was drawing on the when the RL10 goes through the belly of the Dragon, see, price already has, but the RL10 is only right here. When the RL10 goes through the belly of the Dragon, you can execute. When price goes through the RL10, you can execute. That'll make sure that you get in before it collapses. The main point is that most of the guys who have their stops down here are below the swing low of the bar. So as long as you're executing at the bend of the RL10 or the Dragon, this is the thing that makes it collapse huge, is when all of those little things that are below the wick. So you're actually front running that. As long as you get in before that goes snap, crackle, pop, you're going to be fine. But my priority and my preference is price below the RL10, execute. Now, interestingly, this is not the same on the buy side because this is driven by fear and the upside move is normally a grind. So it is much less common to see runaway price moves forever. They are much more likely to grind. So you can actually wait for the RL10 to cross the PSAR or cross that. And by the way, the same logic applies, that the trigger is either going to be the RL10, or if it was up in here and started to fail, you say, hey, do I execute when the price hits the PSAR or when the RL10 hits the PSAR? On the downside, I execute off price when I want to get into a short side position. If it's a long side trade and my stop is the PSAR, price. It's just easier that way. Let the price be your trigger on those. Refine it later when you have a lot of data and you can answer the question from your own trading and your own analysis. that's everything for today. We'll get this published and posted shortly. I'll be back in about 2 minutes with the daily podcast. Actually, in about 15 minutes, I still got to, I think, finish one page of the reports. See you in 15.